Welcome to the Explainer. So, you donate to a charity in India. You'd expect 100% of that money to count, right? Well, what if it doesn't? A recent change to India's tax laws has created exactly that puzzle for nonprofits. We're here to break down what it means for them and, just as importantly, for you.
Yeah, that question probably sounds a little weird, but it's actually at the very heart of a huge new tax rule that's changing the game for charities all across India. How is it even possible that a donation isn't fully counted as, well, a donation? Let's dive in.
Okay, so here's how we're going to break this all down. We'll start with this new rule. Then we'll see who it really affects. After that, we'll cover the basic principles for all charities, look at what it takes to stay compliant, and then wrap up with a handy guide for donors like you.
All right, so this whole thing kicked off with the Finance Act of 2023. One single new rule created a pretty significant ripple effect across India's entire nonprofit sector. So let's start right there. So check this out. Before 2023, it was simple. Charity A gives money to Charity B, and Charity A could count 100% of that donation towards its own required spending. But now, with the new rule, only 85% of that donation qualifies. Let's see what that actually looks like with some real numbers.
Okay, let's put some numbers to this. Imagine a big foundation donates, say, 1 lakh rupees to a smaller, local charity that's doing amazing work on the ground, maybe running a health clinic or a school. The full 1 lakh is sent, and the full 1 lakh is received.
But here's the catch. Under this new law, only 85,000 of those rupees actually get recognized as applied income. That's the official term for money spent on charitable work. So suddenly, there's this 15,000 rupee gap the foundation has to figure out how to fill from somewhere else. The big question is, who does this really affect the most?
Right, so this new rule, it doesn't hit all nonprofits in the same way, not at all. It actually creates a pretty sharp divide between two main types of organizations, the ones that give grants and the ones that are, the doers on the ground.
So let's break down that difference. You've got your implementing NPOs. These are the folks on the ground, running the schools, the clinics. Their spending on staff and programs is fully counted, so this new rule barely touches them. But then you have the grant-making NPOs. Their entire reason for being is to fund those other charities, and they're the ones who get hit hard. Why? Because their main activity, literally giving money away for good causes, is now effectively penalized.
And this really puts them in a tough spot. To meet their minimum spending requirements, these grant-making foundations might now have to spend every single rupee of their income each year. I mean, think about that. That could mean leaving absolutely nothing for reserves for a rainy day, which puts a ton of pressure on their long-term stability.
Okay, to really get the full picture here, we've got to take a step back and look at the basic foundational rules that all tax-exempt charities in India have to live by. These are the fundamentals that the whole system is built on. You can really think of these as the pillars of trust. First off, every charity has to have a clear purpose, and this is key, it has to spend at least 85% of its income on that purpose. And critically, nobody involved, not the founders, not the trustees, can personally profit. Everything else you see here, the audits, the tax returns, the record keeping, it's all there to prove it and, to maintain that public confidence.
And when we say charitable purpose, the law is actually pretty broad. It covers a huge range of activities, everything from poverty relief and education to preserving the environment. This is great because it allows for a really diverse and vibrant nonprofit sector, but it does set some clear boundaries.
And here's another really interesting rule that's all about transparency. See, charities can get anonymous donations, but there's a limit. If they get anonymous gifts over a certain threshold, that money gets taxed. It's just a way to keep things above board. It's worth pointing out, though, that most religious institutions are actually exempt from this specific rule.
So for these nonprofits, following all these rules isn't just, good practice. It is absolutely essential for their survival. The deadlines for reporting are super strict, and the consequences for not complying, well, they're pretty severe.
Just look at this timeline. It shows that critical annual cycle of compliance. It all kicks off with reporting all the donations they received by May. Then they have to file their audit report in September. And it all wraps up with the income tax return in October. Missing any of these deadlines can trigger some really serious problems.
So what kind of problems are we talking about? Well, one of the biggest ones is something called the exit tax. Basically, if a charity loses its registration, or if it tries to convert into a for-profit business, or just dissolves improperly, it gets hit with a massive tax on its entire net worth. It's a really powerful deterrent designed to protect the money that was meant for charity. Okay, so we spent a lot of time on the rules for the charities themselves, but now let's switch gears and bring this all back to you, the donor. Because honestly, understanding this landscape helps you make your contributions way more effective, and it also makes sure you get the tax benefits you're supposed to get.
Now, the tax deduction you can actually claim really depends on where you donate. If you give to certain government funds, like the Prime Minister's National Relief Fund, you get a 100% deduction. Awesome. But for most other registered nonprofits, you can claim a deduction for 50% of the amount you donated.
But to get that 50% deduction, there are a few conditions you've got to meet. The NPO has to be registered, of course, and it can't be for a specific religious community. Also, the total amount you claim is capped based on your income. But honestly, one of the simplest rules to remember just comes down to how you pay.
And here it is. This number is super simple, but absolutely vital to remember. If you want to claim a tax deduction for your donation, anything over 2,000 rupees has to be made through a check, a bank transfer, or some other digital payment method. Cash just won't cut it for those larger amounts.
Okay, and one last really important point for all of us donors. While giving things like computers or food or medicine is incredibly valuable, I mean, it's super helpful for the charities, these in-kind donations, as they're called, unfortunately do not qualify you for a tax deduction under Section 80G. The benefit is purely for the organization receiving the goods. So all of this leaves us with a pretty big fundamental question. What's the right balance here? On one hand, these rules are meant to build public trust through accountability, which is great. But on the other hand, could they, especially this new 85% rule, end up creating hurdles that actually slow down the vital work happening on the ground? It's really a core debate between regulation and enablement, and the answer is going to shape the future of charity in India.